Good afternoon, ladies and gentlemen. A very warm welcome to the JKH Investor Relations webinar for the year ended and fourth quarter ended 22-23. And thank you very much for joining us today. My name is Bihan Kure. I'm the Deputy Chairperson and Group Finance Director. I'm joined today by our Chairperson and CEO, Krishant Balendra. The proceedings or format for today's presentations will be where Krishant will initially take us through an overview of the macro and some of the key highlights. And thereafter, as we always do, I will take you through a presentation on the key financial aspects of our performance for the quarter and year ended 31st March 2023 and some of the key highlights. Before we start, I'd just like to remind you that if you have any questions, please enter it into the Q&A tab at the bottom of your screen. With that, I'd like to start off proceedings by inviting Krishant to give us a brief overview. Thank you.
Hi, good afternoon, everyone. Thank you for joining the JKH Investor webinar. I will start with giving a brief overview of the situation in the country, especially for those of you who are joining us from overseas. As we have said at the last two webinars, the situation on the ground has improved vastly. It's actually normal compared to the mid last year during the height of the economic crisis. The country's reserves have improved. We are finding easy access now to dollars in the banks for importing our materials and construction equipment. The problems we had, as you know, mid last year, where obtaining dollars was a challenge. Today, there are no issues at all. The rupee has appreciated about 20%. Inflation has started decelerating from the peak of over 70%. In April, it was 35%. And expected to be much lower in May and keep falling thereafter. Tourism is also picking up. It took some time for tourism to recover, longer than we expected after all the bad publicity last year during the crisis. However, now looking at the numbers in May, we expect that we would have about 60 to 65% of the arrivals we saw in May 2018, pre-COVID. Looking at our forward bookings and the momentum, we expect that by the peak season, by December, that tourist arrivals would be almost back to pre-COVID. The IMF program is progressing well from everything we can hear. The next review is due in September. There has been an IMF team on the ground. The next big event is the details of the domestic debt restructuring, which is expected to be announced quite soon. Government has also announced a number of privatizations and other economic reforms and SOE reforms. They are now in the process of choosing advisors for the privatizations. On our key projects on Cinnamon Life, construction is now progressing very well after the disruptions of the last 3 years with COVID and with the economic crisis last year. The 2 apartment blocks and office tower are completed, as you know, and gradually getting occupied. The hotel and the mall and the gaming area we expect to be completed in the second half of the next calendar year, second half of 2024. On the gaming, we are now in advanced discussions with some leading gaming operators, international gaming operators, and we are hopeful that we would be able to finalize something quite soon. The West Terminal construction is now progressing well. You will see some images during the presentation. The dredging and reclamation of the terminal is now completed, actually completed ahead of time. As we said, we expect the first phase of the terminal to be operational in December 2024, and it is very much on schedule to start operations as we have announced previously. So I will hand over to Gihan, and also we will be here for questions thereafter.
Thank you, Prashant. So we can move on to the presentation, and as I mentioned earlier, I will take you through the performance for the fourth quarter and the financial year. So there's two different aspects we'll be talking of, and we've also included some further analysis to help you understand the key drivers of the core performance of the group. So there is a little bit of detail, and we'll try to sort of take you through that. So if you look at the recurring EBITDA for the year, we've seen group EBITDA go up 17% to 45 billion from the 39 billion. So we've maintained that strong momentum that we saw in the previous years' numbers as well. We will take you through some of the detail of where this is, but if you look at the slide, you'll see that a lot of that growth is coming from across the businesses by and large, mainly by transportation, but we've seen our retail leisure business also significantly contributing. We've seen an impact on the property side, which I'll talk to you about, but right across the board, we've seen group EBITDA seeing growth. We did have recognition on the sale of apartments of Cinnamon Life in the last financial year, which was mainly in Q4, but we also see that impact in Q3. So the number you see here, we've just adjusted that out to show the group EBITDA, excluding that last year was around 33 billion. And if you look at this year's performance, there was no sales from Cinnamon Life. So if you look at that as a growth, there's a significant growth X of the contribution coming from Cinnamon Life. Just to take a step back and look at the annual recurring EBITDA numbers going back a couple of years as well. So as I mentioned before, you see the 39 billion that we did in the last year. But if you look at it, of course, the previous 2 years are pandemic affected as well. But still off that sort of base, we've seen a significant rebound in the EBITDA, and that sort of momentum that we saw in 21-22 from that significant rebound has continued to maintain. Moving on to the recurring EBITDA for the quarter. Here again, I'll explain some of the slides but through the detail, but the main impact you're seeing is the impact of Cinnamon Life. So in terms of reported group EBITDA, you'll see that there's a drop from 18 billion to around 11.5 billion. But as I mentioned before, we had around a 4 billion impact coming from Cinnamon Life. So if you exclude that, you see the performance still did see a decline, as some of the challenges we've been speaking about have started to impact our businesses. So if you look at our transportation business, you'd see there was a impact there. The standalone performance actually in Q4 22-23 is still very strong. It's just that as a comparative, when you look at Q4 last year, we had a very, very strong quarter with some exceptional sort of contributions coming in as well, with base oil prices going up and sort of benefiting on the margins on inventory and so on. So that has sort of normalized to some extent, which is why you're seeing that reduction. Consumer foods, we've seen some challenges as we've been speaking through in terms of margin as well as volume, and we'll talk to you more about that as we go through the rest of the presentation. Those were the two main areas, and of course property, the drop. We've shown you what's happened with Cinnamon Life. Again, just to show you the quarterly recurring EBITDA movement, I won't spend too much time on this slide. So whilst we have seen still an impact in Q4, if you look at the absolute number and you look at it right across the 4 quarters, the 11.5 billion for Q4 is still quite robust in terms of the contribution. Though if you look at it against last year, yes, we've seen a decline. But looking at it from Q2 to Q3 to Q4, it's still a very healthy absolute contribution coming from recurring EBITDA. Just moving on to understanding the PBT performance and trying to give a little bit more color. There have been a lot of one-offs that have happened last year as well as this year due to the environment as well, with exchange gains or losses being quite significant gains in this instance. And of course, some other one-off items that happened in the last year, which I won't spend too much time, but we've put this slide together to help you understand how the reported EBITDA moves to a the reported PBT moves to a recurring PBT. So last year, the main impacts was a exchange gain of almost 13 billion. This year, we had around a 6.6 billion, so a lower exchange gain. But if you adjust that out, and of course, there were some other one-off adjustments, the recurring PBT is a 24 billion coming down to 17 billion in the current year. But as I mentioned before, we have a 6 billion contribution from Cinnamon Life. And if you adjust that out, you'd see that the recurring PBT, excluding the contribution from Cinnamon Life, is around a decline of a billion. And of course, I will talk to you more about why that decline has come about, and that's largely coming from some of the finance expense related impacts that we've seen due to the macro environment and significant increase in interest rates in the country. So if I just give you some more detail here, you'll see in 21-22 our total finance expenses or costs was around 7 billion for the year, and that has increased quite significantly to 17.8 billion. And if you look at each of the businesses, you'll see the increases come right across relative to what they have, but a significant jump in retail and leisure, and of course other, which is the comprises of the holding company. Some of this is naturally rate driven, or most of it is rate driven. We've also had impacts of the rupee equivalent of the interest cost. So with the depreciation of the rupee and the dollar borrowings that we've had, so when you translate that interest cost into rupees, we've seen a jump on that, though the absolute dollar term might be the same. And with the Fairfax debenture as well, we have a non-cash notional interest charge of around 1.8 billion that's coming to this number. So those are the main reasons why we've seen the significant increase in interest cost. And the performance that I showed you in the previous slide is notwithstanding or despite this 10 billion rupee increase in the finance cost. Similarly, if we move on to understanding the finance costs for the quarter, we again see, if you look at Q4 here, you'd see a 2.1 billion finance cost for Q4 last year, which has now increased to 5.4 billion in this year. So it's about a 3.3 billion rupee increase in the finance cost year on year. And that again is due to the same sort of reasons. The numbers are different, but I won't repeat what I already mentioned previously. The good thing is if you look at Q3 to Q4, in Q3 we had 5.3 billion as our finance cost, and in Q4 now it's 5.4 billion. So you're starting to see what is hopefully a peak and a plateauing and then a reduction of the finance costs. And if you look at some of the line items, you'll see, particularly if you look at areas like retail, those finance costs have started to decline as some of those additional working capital investments that we had to make during the last year, particularly Q2, 3, to ensure that supply chains were less disrupted and so on, that those impacts are now falling away or have already fallen away. So as a result of that, you're starting to see that benefit come through as well. Looking at the recurring PBT for the quarter ended 31st March, here again, just to help you understand some of the movements here. So if you look at Q4 last year to this year, there is a significant decline in the recurring PBT. But if you look at it again, I spoke of this number, the 4 billion that's come in Q4 on the Cinnamon Life apartments. So if you strip that out, that explains part of that delta of the 11 billion that we are seeing. And we've seen about a 3.3 billion rupee increase in the finance costs as well, if you look at it on the quarter-to-quarter basis, as I just explained. So most of that movement is actually explained through those two significant factors. But apart from that, we have seen some impacts, particularly on the consumer side, coming through with the current macro environment and the impact on consumer discretionary spend. And we'll talk to you a little bit more about that when we get to the business updates. On the financial indicators on the balance sheet, we've seen our debt levels coming off slightly. So with the current rate of the rupee appreciating as well, there was some slight benefit. But apart from that, we've seen total debt. This is excluding leases and the convertible debenture as well. We're going on the basis that if it does get converted, but we've also shown you the number with the convertible debenture. So it's 211 billion rupees without, which is a decline from the 234 billion that we saw last year. Cash has declined to about 100 billion as expected, as we've continued to infuse funds into Cinnamon Life as well as fund the West Container Terminal. So as a result of that, we've seen net debt increasing from 77 billion to 111 billion. But if you look at the ratios in terms of net debt to recurring EBITDA, still at a very healthy level of 2.4 times compared to 2 times last year. And of course, our net debt to equity is at around 30%, which is quite comfortable. Moving on to some of our ESG related initiatives for the financial year, we've seen our carbon footprint come down quite materially, as well as our water withdrawal as well. So on an efficiency basis per million rupees of revenue, we've seen these indicators coming off quite significantly. Apart from that, we had some key initiatives during the year as well. One was to reformulate our whole ESG framework or strategy. We've got some international expertise to look at it to see how we can take it to the next level in terms of ensuring there's that much more collaboration in terms of the strategy between our businesses and the whole core as well. We had a significant donation of 100 million rupees to the Suaseria Foundation, which runs a island-wide ambulance service, and they needed some assistance given the current economic impacts. And we felt it was something that we should support, given how important this service is for our fellow citizens in the country. During the year, we've spoken of this, so I won't spend too much time, but we introduced the 100 days of parental leave, equal parental leave, as well as our DE&I initiatives in terms of our women's participation in our workforce. We've seen good traction on some of the initiatives. In terms of the number, it hasn't really moved, but it's a 5-year target that we've embarked on. We are quite pleased with the progress we've made so far. Moving on to our business updates. We start with our transportation business, and I'll move to the next slide. Before we get to the numbers, if you look at the progress, Prashant also touched on it earlier, we've made significant progress on the West Container Terminal. So the image you see on the left of your screen essentially is before, this is the breakwater and before any reclamation was done. And with the dredging works and essentially completion of the reclamation, what you see on the right hand side is essentially the entirety of this area has now got reclaimed, which would be the which is about 65 hectares that has been now reclaimed. So you can see the scale of the reclamation here. At the back here, what you see is the CICT there, so you can see the scale of the reclamation and progress on the construction, and the award of the quay wall construction as well has happened. So we are quite pleased with the progress we've made so far on the West Container Terminal. In terms of the performance for the quarter, we've seen a slight decline in the volumes in line with what the port has seen. Actually, the decline is slightly less than what the Port of Colombo has seen. This is largely given the environment of regional trade as well. It's not necessarily a trend we expect to continue seeing, but we've seen some slight stress on regional trade because of the global issues, and that's what's reflected here. but we've sort of increased our market share slightly during the quarter. The bunkering business saw volumes flat. Overall, as I mentioned before, we've seen a decline in recurring EBITDA, largely because last year had some exceptional performances, and this is sort of more normalized run rate that we're seeing in terms of the transportation business performance. Moving on to our consumer foods business, if you look at the quarter, and at the last webinar we spoke of some of the challenges we were seeing in terms of consumer spend and the decline or pressure on volumes. So that has sort of compounded a little bit further. So Q4, we've seen volume declines being quite material or significant, with our ice creams business seeing a 30% decline and our beverages business seeing a 40% decline in volumes. And that has naturally translated to sort of impact on recurring EBITDA margins and overall recurring EBITDA. So it's something we are monitoring quite closely. The good thing is, if you look at the month of April, we've seen a rebound in volumes, not a growth, but the pace of decline has slowed down, and we're seeing the volume decline being less. It's a little too soon to assess whether that is the normalized level or not. But as we've seen the impacts of inflation and particularly the tax increases and so on taking place, we've seen this decline come through. But it's an area where we're focusing a lot in terms of how we manage our cost structures and so on. As we've spoken before, we're starting to see some margin improvement, notwithstanding the impacts on operating leverage, but on a product margin basis, which I'll talk to you about. If you look at the annual numbers, naturally the first half was quite strong, so you still see the decline in ice creams and beverages being limited to a decline of around 7%. But in terms of Q3 and Q4, we started to see naturally much faster decline. Just looking at the margins, we've spoken of this before, and if you look at the chart on the right hand side, you'll see here we're starting to see that impact of some of the reductions of the raw material prices as global freight rates have declined, the appreciation of the rupee has helped, and commodity prices have come off. So with all these sort of combined impacts, we're starting to see the effect of this. We did have to stock up, as we spoke before, because of some of the supply chain challenges. A lot of that inventory, of not all, has now got depleted. So we'll start to see this benefit translate even more to product margins as we head into the next couple of quarters. We're seeing a similar sort of decline on frozen confectionery on some of the key items as well. And like I said, this will help with product margins going forward. Moving on to our retail business, the business here has seen quite a strong quarter. Overall, the supermarket business actually did quite well. If you look at the same store sales, naturally driven by inflation, but we've seen 30% growth in same store. Footfall, we've been seeing strong growth. If you look at a quarter to quarter comparison, last year we saw a significant sort of increase, but still we managed to sort of maintain footfall at similar levels, and basket values have grown. So our overall EBITDA margins, recurring EBITDA margins, have been maintained at around the 7.7 mark, which is what we saw in Q3, despite some of the cost pressures that have come through, including things like electricity tariffs, as well as the revenue-based tax that came through, which was the social security contribution that also came through. So we had to sort of renegotiate and ensure that we protected our margins. And you're sort of seeing that from Q3 to Q4, which is quite a positive. So overall, the supermarket business, actually, the EBITDA grew. The reason you're seeing a decline in Q4 is due to the office automation business, which has seen a decline compared to last year. And that's where we have the mobile phone sales, and we've seen a drop there, which is the main reason for the decline. But like I said, the supermarkets business has actually seen a growth. If you look at the annual numbers, we've seen overall growth driven by footfall. So the annual footfall growth has been quite strong, and that's an encouraging trend that we've continued to see. So 28% growth in footfall and ABV growth as well, which contributed to a strong same-store sales performance, and the annual recurring EBITDA margin at 7.5% is still fairly healthy. Just breaking down the same store sales, if you look at the footfall and ABV, I touched on this briefly earlier. So if you look at ABV, which is on the right hand of your screen, you see a 30% growth in ABV, driven mainly by inflation. So inflation in March was around 49%. So you're still seeing that impact on consumer behavior, where despite inflation being higher, the ABV is at 30%, which is due to the fact of the drop in the weight of purchase, or the number of units essentially bought by consumers. So you're still seeing that impact of consumer behaviors being driven by the impact of inflation. Footfall, as I mentioned, has remained largely in line, a marginal growth, and combined, of course, it helped translate to a same-store sales growth. Moving on to our leisure business, we've seen arrivals to Sri Lanka, continuing to show a recovery trend post the economic and social issues that we had mid last year. So we've been sort of trending or averaging around 100,000 arrivals in Jan, February, and March was a little higher. Now we're getting into more of the off season, but even in the month of April, we've done around 100,000. So this is at around maybe roughly 60% of the pre-pandemic numbers. And we expect to see this trend continue, the recovery trend continuing. So if you look at 2022, you'll see from May or even April onwards, the numbers really did fall off quite significantly. So off that base, certainly we will see a very, very strong growth. But if you look at it and compare it with 2019, we still expect or hope to see a full recovery to those pre-pandemic numbers, hopefully by end of this calendar year. The connectivity to Sri Lanka has continued to sort of improve. We've seen new airlines coming in as well, and obviously that's an important factor that will help drive this recovery. Moving on to the Maldives, we've seen continued growth in the Maldivian numbers. It's by and large in line with the pre-pandemic numbers. So if you look at March, April, it's in line with the pre-pandemic numbers, and of course a growth compared to 2022. Looking at the leisure occupancies for the group, I won't go through each of these. Maldives, of course, you've seen it being at around that 90% mark throughout the 4 quarters. In Sri Lanka, of course, you've seen the decline in Q1 too because of the issues, but we've seen a rebound to around 60% on average in Q4. Looking at the numbers, I won't go through each of these numbers, and these numbers are available on the deck for you to look at later. But we've seen a significant sort of rebound in Sri Lanka off the base. And if you look at it compared to Q3 to 4, of course, Q4 is the peak season, so it's not an apples to apples comparison. But if you look at Q4 last year, we still had a fairly good, robust Q4. So compared to that, if you look at Sri Lankan resorts, the ARRs have come down in dollar terms, and largely because of the depreciation of the rupee. So the local component, whilst we have repriced, it's obviously not repriced to the extent that we've been able to maintain our dollar ARRs on the local pricing, and that's been the same across the board for the industry. In the Maldives, we've seen occupancies being maintained compared to Q4 and ARRs being marginally down, but overall EBITDA margins at 40% is still healthy, and that has all translated to a growth of around 600 million in recurring EBITDA. The leisure performance for the financial year, I won't go through these numbers. Moving on to Cinnamon Life, just some images. It's what you all have seen before. I'll just skip through these fairly quickly. Krishan already spoke of the status of Cinnamon Life and how we've made progress. We'll be happy to take any questions during the Q&A. Moving on to our property business, we haven't seen much traction in terms of sales on both Cinnamon Life and Trizen, something we've been talking about in the last couple of quarters, naturally still with interest rates being quite elevated, as well as the current macro. There's not enough confidence for people to still make those decisions, but we've seen an increase in inquiries, a lot of engagement as well. And we are quite confident that we'll stay patient and we'll see traction as things stabilize and normalize, that we will see sales rise. And we've already sold 655 units of the 890, so that's still quite a high degree of sales completion. The recurring EBITDA in this business has fallen significantly, mainly because the 4 billion of the recognition of Cinnamon Life that I spoke of earlier. Moving on to financial services, here we've seen a strong performance coming through from both the insurance business and the banking business, which has resulted in the recurring EBITDA increasing from 1.1 billion to 1.9 billion, which is a significant increase. Union Assurance, we've seen continued GWP growth, strong performance on writing of new business as well. So despite the current environment, we've still seen growth in the business and a strong surplus as well for the year, which contributed to the strong performance. And NTB as well, despite all the challenges the banking industry has faced and the impairments on ISBs and some of the other areas, we've still seen strong growth driven by very healthy NIMs, fee income as well. So loan growth has marginally declined in Q4. Stage 3 loan ratios have been generally managed, so they have edged up naturally in line with some of the stressors in the economy. But overall, and as we've mentioned, given the relatively low exposure on the international sovereign bonds as well, and a very high proportion of the provisioning that we've taken, the performance of NTB has been also quite strong, which has combined with insurance to result in quite a strong number for the financial services business. So that brings us to the end of our presentation. We will now open up the floor for any questions. Once again, I'd like to remind you that if you have any questions, to please enter it into the Q&A tab at the bottom of your screen. So just to kick things off, Krishan, if I can pose this question to you. There are some concerns that with the increased capacity at the Port of Colombo, with both West Container Terminal and ECT due to commence operations around the same time, as well as given some of the port capacity expansions in India, whether there will be insufficient demand to meet this increased capacity both in Colombo as well as in India. Any comments on that, Krishan?
I think West Terminal will add 3 million TEUs plus, and East Terminal as well about 3 million containers. The current capacity of the three terminals that are operating put together is about 7.5 million TEUs. So you're seeing almost a doubling of the capacity in Colombo over the next 2 to 3 years. In India as well, there is port capacity coming online. However, at the time we did the feasibility for West Terminal, we had one of the leading maritime and shipping research houses that do this kind of traffic data to assess the potential for Colombo with new capacity coming in, and in the context of the capacity in India and in the region. And at the time we did the feasibility a few years back, they were positive that there would be enough traffic to absorb the new capacity. And then recently, just a few months back, we updated that report and the numbers were actually even more positive. So we are confident that despite the new capacity, that it will get absorbed and absorbed quite quickly. Now, while there is new capacity coming online in India for a large vessel that has boxes or containers for multiple countries, it is still more convenient and saves more time to drop off in Colombo because the deviation to an Indian port is that much greater. So all the research and forecasts indicate that the new capacity should get comfortably absorbed.
Thank you, Krishan. I think you've covered this, but I think there's a sort of different question that might be related to what you just spoke of in terms of the competitive threats to WCT. So I think that's possibly by and large coming more from India.
Yes.
So maybe in terms of the strategic location and advantage that Sri Lanka has, I think we have enough of an advantage to really
Yes.
capitalize or overcome those competitive threats.
Correct.
And that's what I think the traffic studies are also indicating.
Most of our transshipment goes to India and to Bangladesh. And this is the two countries. India in particular is the fastest growing big economy in the world. And if you look at other regional ports in more developed zones, the capacity is so much more. As I said, Colombo's capacity will go up to about 13.5 million containers when both West Terminal and East Terminal are operational. But the capacity in Singapore is over 40 million. In the number of ports in China, they each have a capacity of over 25 million containers, and Hong Kong has a capacity of around 20 million containers. So as the major transshipment hub port in South Asia, I think we have enough room to keep adding capacity.
Thank you. Thanks, Krishan. Just moving on to some questions on relating to cinema and life. I think we did cover this, but there's a question in terms of just understanding the timing of the gaming, the casino opening as well. And yeah, maybe if you can give a little color on that.
We would
Krishan.
like to time the casino opening with the opening of the hotel and the rest of the mall. So as I said earlier, we are looking at opening the second half of 2024 calendar year. So we expect to open the hotel and the casino at the same time.
Yeah, there was another question. So just to sort of reiterate the point, the idea is that we would expect to open both together around the same time to sort of maximize the impact. And it is that sort of alignment of timing that's driving the opening date for Cinema Life. Krishan, just moving on to the property business. What's the way forward for the property business post completion of Cinema Life and Trizent, which are the two sort of ongoing projects? Are there any other projects? Maybe we could just add some color.
We had a 10-year plan pre-COVID and pre the economic crisis. We have a substantial land bank in the heart of Colombo, 9 acres on Vauxhall Street. There is more undeveloped land adjacent to the Cinnamon Grand Hotel, significant land adjacent to the Cinnamon Lakeside Hotel. And we also own substantial amounts of land in the suburbs of Colombo, which are right on the outer circular highway. So with the crisis and the slowdown we have seen in the higher segment of the market in the heart of Colombo, we may have to defer some of the development, or we probably will have to defer some of the development plans in the heart of the city. But we are currently looking at the suburbs where we are seeing, interestingly, some momentum with developments launched by other developers. As I said, we have the land, and that could be the next development that we launch. But Colombo and the heart of Colombo is also very much in the pipeline, given that we have a significant land bank.
Thanks. There's a question if the Cinema Life is viable at the $200 rates that competition is currently getting. I think what we mentioned before is that Cinema Life will sort of be a catalyst for creating demand. We have almost 5,000 packs that we can cater to in terms of the multiple banqueting and conferencing venues, and of course being a proper integrated resort that we can attract numbers in, and the sort of contribution coming from the traffic that comes to the gaming space as well, and the rental that we get from the totality of the rentable space in the development. So we think that given the value proposition of Cinema Life and the integrated nature of the development, that we will be able to command rates. Ultimately, it depends on, yes, what is out there in the market. But if you look at Sri Lanka, and we've spoken of this before, we did 2.3 million tourists before the pandemic, but that's really not achieving on anywhere near the potential for the country. And if you look at a million tourists or 2 million tourists coming in over the next couple of years, and looking at the number of rooms, 5-star rooms in the city, that can get absorbed very quickly. And I spoke of course, cinema and life being a catalyst for creating demand into the city, with both conferencing and gaming contributing to that. So overall, I think, we could see upside to these numbers, and of course, certainly in terms of the contribution to cinema and life as well. There's a question on understanding the current situation of the retail and consumer foods volumes and margins. I think we did speak through that during the presentation, but maybe just to clarify, naturally there's two elements to this. In consumer foods, we've seen a significant decline in volumes. So when you see a decline in volumes to that extent, there's a lower dilution of the fixed cost or operating leverage that we lose out on. So that naturally translates to a negative impact on margins. But like I also said during the presentation, and we've been saying in the last quarter or so as well, we've started to see product margins starting to see that recovery, because the cost increases that we had to undergo, we've sort of seeing that reversal of those impacts as well, and the price increases that we've undertaken. So we are starting to see that recovery on product margins. So it's too soon to give an indication as to where volume recovery will be based on consumer discretionary spend. But as I alluded to, we've seen in the month of April and May some sort of stabilization, not to say it's not declining, but certainly not to the extent that we saw in Q4. But whether that's a reversal or not, we'll have to watch and see, because it's a little too premature to draw any conclusions with just a month or two of that performance. There's a question on how many retail outlets we will be looking to add. As we've said before, we've been a little cautious in terms of adding outlets in the last 12 months or so, given the significant increase in the capex and the uncertainty actually that the country is seeing on construction costs as well. So we didn't want to construct too many outlets, spending possibly what was then a peak, and we've started to see construction costs coming off, with commodity prices coming off, as well as the rupee appreciating, and the uncertainty that contractors or people were also pricing in because of the environment we were faced with, say, 6 months ago. So with all those factors now more in favor, you have better clarity on construction costs. But it's not like we haven't opened outlets. We have a couple of outlets that are currently in the pipeline as well. So over the next year, you will see us open maybe 5 to 8 outlets, and we'll continue to assess and look to expand. Overall, we are still very positive in terms of the potential for the number of outlets to increase in the country. The density of outlets that you see right now is still well below what you see as regional benchmarks, and that opportunity is very much there for us, and we will continue to look at that. So whilst the investment per outlet also has increased, on the other hand, we see the benefit of revenue per outlet also coming through. So the payback sometimes may be not as affected, but still will be a little more cautious, continue to stress test our feasibilities a little more than we typically used to. But certainly the outlet expansion can and will continue. Krishant, there's a question on what drove the 62% occupancy in city hotels in Q4, and whether that was driven by business traffic or tourists, and what are we seeing in terms of expectations for the current quarter as well.
It was a mix of business and tourist traffic. We find that the European tourists generally don't spend time in Colombo. So it was a pickup that we've seen in arrivals from India in particular and from the region, the tourist arrivals and the business increase in business traffic. Also, Colombo, the occupancy did see some increase from this, or significant increase from the casino segment of the market as well, primarily from India.
Will there be any refurbishments, Krishan, in the Colombo hotels coming up? Comment here is that we see that few competitors have already kicked off refurbishments.
Yeah, nothing imminent. We will watch the market. We have Cinnamon Life coming in, and once Cinnamon Life is operational, depending on the demand at the time, we will look to refurbish the properties.
On leisure, Krishan, I know we don't comment on margin expectations, but there's a comment that could we get an estimate on the potential margin growth via the proposed electricity tariff reductions, especially given the LKR appreciation. But I think point to point, the thing is that the tariffs were still quite negative.
Yes.
So I think it's more a question of how we see occupancy is recovering and that impact coming through. There was also a question on the dollar ARRs coming down. So I think I spoke of that, where part of the reason is that the local component of revenue coming through in terms of yields, naturally that translates to a lower dollar ARR, because it's not like the rupee pricing on yields have increased sort of 60-70% to compensate for the fall in the rupee. But as we get more foreign arrivals coming in, you'll see that the dollar blended ARRs will start recovering, because the dollar ARRs there, we will have some maybe lower pricing, but it's not like it's deeply or heavily discounted. So you will see that blended ARRs starting to show a stronger or better recovery. There's a question, Krishan, on the current mix of the foreign and local guests at the Sri Lankan resorts. I think we already sort of covered something, but maybe if you can give a little more clarity.
Yeah, I mean, pre-COVID, the domestic segment had grown to almost 25% of occupancy in the resorts. And then during the easing of the lockdowns, we saw a big surge. Obviously, it was almost entirely domestic. With the crisis last year and the issues around availability of fuel, and then with the fuel rationing, the domestic component has come down. But we expect that it will, over the next few months, it will recover, and that it should be back to like 20 to 25% of occupancy in the resorts.
There are a couple of questions on the apartment sales. One is on the plan for Cinnamon Life apartment sales going forward and the office flows. So the sales will continue. Like I said before, the challenge we are seeing is with the elevated interest rates and macro conditions. Whilst we're seeing inquiries, these haven't still translated to sales. But on Cinnamon Life, we're very positive naturally with developments on the gaming, and as we get closer to completion, that we will certainly see not just inquiries, but these actually translate to true sales. So as we make progress on both fronts, I think we will certainly see things getting better. On the remaining office floors, whether we plan to rent out or sell floors outright, so it's a combination. We will sell floors as well, and that's something we are working on. And some of the remaining floors that we have will be leased out, so that's a combination of the two. In terms of Trizen, there was a question when handing over is expected to be. So the timelines we've mentioned in terms of Trizen being completed by end 2023 is very much on track, and then thereafter we will start the handover process. Given that it's 891 units in total, of which we've sold 650, the handover itself will be somewhat staggered. But certainly we will be on track to start handing over post completion end of 2023. There's a question, Krishan, given the strong occupancy in the Maldives, whether there's any expansion plans for new resorts there.
Yes, we are looking at new opportunities not only in the Maldives but elsewhere as well. We have 4 properties there, so it's a little concentrated in the Maldives. But if there is an opportunity that fits in with our portfolio and with our brand, we are open to looking at it.
There's a question on leisure again, Krishan, so I'll put this to you in terms of forward bookings and package tourism seeing improvement with China opening up and any sort of charter flights or tours that have been sort of coming in with the Chinese market opening up.
China has picked up, but it hasn't picked up as quickly as we expected. Pre-COVID, we had about 40 flights a week from China. As the lockdown was eased in China and the travel restrictions were removed, the initial announcements indicated about 16 flights a week from China, but demand has been low. So what we are seeing right now is only about 6 flights a week. Looking at some of the polls that are coming out, the sort of surveys that are coming out of China, it looks as if the Chinese will really start traveling from July onwards with the school holidays. So we should see a pickup then. So we have, of course, seen numbers from China, but it's below what we expected in the last couple of months.
There's a question whether there are any investments planned that fall within as opposed to adjacent to the port city area.
No, there isn't anything imminent, nothing planned.
There's a question on the operating margins of the manufacturing and supermarkets business. I think we've already sort of covered that, particularly on the supermarket side. We've seen EBITDA margins at 7.7%, which is maintaining the trend we saw in Q3 as well, despite some of the cost implications that we've seen and had to absorb. So overall, I think we, particularly on the supermarket side, we will see that sort of margins being fairly strong. On the consumer side, I think I don't want to repeat this too much, but whilst the product margins will recover, it will also depend on what type of volume recovery we see. So it's a little difficult to comment on margins going forward because it will depend on how volumes are. There's a question on NTB's exposure or the treasury bond investments that are in the portfolio, like most of the other banks as well, and how that will be affected or based on the debt optimization or debt restructuring that's undertaken. As we've said before, in terms of no bank will be spared of the impacts of a DDR, but we've stress tested the numbers, looked at different types of scenarios, and it's not to say that under every scenario, because it depends on how extreme one could take a scenario, but based on the different stress tests we've done, we see that the liquidity and the impacts to capital can be managed at NTB. As I said before during the presentation, even with the ISBs, we've already taken a fairly high rate of prudential provisioning, higher than some of the other peer banks as well, and that's already reflected in the numbers that are there that you see for last year in terms of impairments, and it's despite that you've seen the strong performance, and overall ROEs of the bank have been very strong for the financial year and even heading into Q1, which has been very strong. So we expect that overall NTB will be able to manage, but like I said, it all depends on ultimately what form or shape a DDR could take place. There's a question just in terms of a tax reversal that was there on the claim of the enhanced capital allowances in our the soft drinks and ice creams business, whether it's fully accounted in the CCS accounts. The answer is yes, it is. I think there's also a question, and what is the reason for that? So that's an enhanced capital allowance on some of the investments, so that arose due to that. I think some of the other questions we've already covered. I think there's one maybe final question that I can take up just in terms of future growth for Union Assurance going forward, Krishan, and any particular challenges that the company is facing. Naturally, there's an impact on, or possible impact on DDR if it does affect the insurance industry, but there again, we've looked at different stress tested scenarios, and under most scenarios, the capital impacts can be managed. But apart from that, Krishan, is there anything else in terms of future growth prospects that we can?
Union Assurance through the COVID and through the crisis has done reasonably well. And in the last few months also, we have seen good momentum and growth. UA is the largest player in the bank assurance segment in the country. And similar to other regional markets, we expect bank assurance to be a big growth area for the business. And we will continue to focus on that to drive growth, but also growth through the agency business. Given how the business has performed over the last couple of years, or last 3 years, in some of the most difficult circumstances, I expect that it will do very well over the next few years as the economy stabilizes and recovers.
There are two questions related to the bunkering business, Krishan, in terms of understanding whether there is an increase in storage capacity, as well as just trying to understand whether LMS has a market leadership position in bunkering, as at the end of the quarter. We can't get into market share details necessarily, but what is the outlook there?
There isn't an increase in storage in the country. There's on-land storage of the Colombo port and the on-land storage with the pipeline in Hambantota. And we have storage in our floating storage. So there isn't an increase in the last few months. We have found that the bunker suppliers are now being supplied by the Hambantota facility. In terms of market share, LMS is, from all the data we have, LMS is by quite a margin the market leader in the bunkering market in the country.
Thank you, Krishan. We are almost at the end of time, and I think we are done with all the questions we've got as well. So thank you very much for joining our webinar. The proceedings of this webinar and the presentation will be uploaded on our website. So if anyone wanting to watch it or share the link can do so. It will be available shortly on our website. So thank you once again for joining us. Wish you a pleasant evening. Thank you.